Welcome, listeners. This is the Pensions Playbook, powered by Access ARM Pensions. We will be speaking on a lot of topics that affect pensions across the industry. Today, particularly, we will be talking about the economic shifts and how it impacts your pensions. I'm sure that most of you might wonder, okay, so why this topic? But as someone who's been in the industry long enough, I know that people always have questions around does inflation affect my pensions, FX, so many of these words that to some of us might just seem quite high, falutin and really, really, really difficult to navigate. But here at Access ARM Pensions, our job is to make sure that we have you educated and informed as our customers. So today I have brought with me a guest. Her name, drumroll, is Ifoma Okoli. She's our Deputy Chief Investment Officer here at Access ARM Pensions with years, guys, I'm telling you, years of experience in investments. Over to you, Ifoma.
Thank you. Thank you for that very energetic welcome. It's an honor to be here. It's a privilege as well. So thank you so much for having me.
You're welcome. So today we'll just like for you to speak to us on how does, all this economic jargon that we hear about in the news, inflation, NPR, FX is going up. How do all these things turn to naira and kobo, and how does it affect our pensions?
Okay, good starting point. Because a lot of times individuals don't really understand the things that affect their savings and investments.
Okay.
And I also appreciate the fact that a lot of people who are not actually in the day-to-day, would find some of all the things you've mentioned earlier very difficult to understand. And it could be a bit tricky because it's necessary for us to understand all these things so that we really know what to do with regards to savings, investments. We make more informed decisions. We're able to interpret things a lot better. So I'll start off with like inflation. I had mentioned. We always hear about, the prices of things have gone up. And I think everybody is living the experience right now of prices going up. It's important, and really that's what inflation really is all about. So inflation is basically measuring the rate of change in prices. And why it's important for pension fund contributors, why it's important for investors, for savers, really, is the fact that you want to ensure that whatever you're saving for in the future, whatever your naira can purchase today, you're able to purchase it in 10 years' time.
So that's like purchasing power.
Exactly. So if I have 5 naira today and 5 naira today can buy me a bottle of Coke, for instance.
Okay.
I would like it that in 10 years' time, that 5 naira can buy me that same bottle of Coke.
Evil wishes were hot.
So that's really what, we're talking about when you're talking about purchasing power. But if today my 5 naira can buy me a bottle of Coke, and 10 years down the line, I can't get half a can, the value of what I've saved has eroded. So our responsibility as pension fund managers really is to ensure that the savings of our contributors generate sufficient returns so that they're able to maintain that purchasing power, their lifestyle at the time of retirement.
So, I mean, the way that what you're saying is, you know how you say, oh, you could live a baby girl life when you were working. And I mean, I had one aunt when we were growing up, and I remember she would always look so good. But as soon as she retired, it just felt like she started to, she wasn't as babe anymore. And I'm sure that this is part of it, right? You would have that because the funds are coming in, you're making money, you're in active service, you're able to buy yourself really nice things. And then, of course, as you get older, demand on what you need to do as a person increases. Tuition for your child at nursery school and tuition for a child who's in university.
Yeah.
Two completely different ball games, right?
Exactly.
Yeah. So yeah.
So to your point, I think for us, it will be good to ensure that your aunt, who is living that baby girl life now, is still able to afford that baby life,
Baby girl life.
that baby life, like
In
then,
the future.
you know, so she'll still be able to afford the life, but you know, by then she'll be older, so she might not be able, she might not have the same level of energy. But our aim is to ensure that her pocket is still as full as it was, so that, you know, the things she wants to enjoy, she's able to enjoy those things.
Okay.
But, you know, it also takes a lot of people need to be intentional about these things. And for a lot of people, saving for retirement is not front and center. And that needs to change, really.
It does, doesn't it?
Yeah,
it does. Because
it does.
I mean, my first daughter, she was talking to me about, you know, wanting to go in for her recitals and all of that. And I was looking at her and I just had a vivid imagination of myself being that age. And I was like, whoa, this time is catching up.
Yeah.
So I think,
yeah.
the set time to start to think about your future, the best time to plant a tree was yesterday. The next best time is today. So if you haven't been thinking about retirement, what's going to happen when you're not as energetic? What's going to happen when you do not have the same, you know, working power?
Yeah.
The time to think about it is now.
Yeah. Yeah. And really to take action.
Yeah.
So just going back to some of the points you had made earlier on the things that influence your pensions. So that's one, like I'd mentioned, inflation. That's just one aspect. You have things like interest rates. So for instance, when the central bank has their monetary policy committee meetings, you see all the information, you would hear, you know, various things. This is the outcome. One of the key things we look to for direction, monetary policy, which is what does the CBN do with regards to policy rates to ensure that there's some sort of financial stability in the economy. So they use different monetary policy tools to achieve that. So one of that is the monetary policy rate, which is the benchmark rate, really. So it influences to a large extent interest rates within the economy. So if, for instance, the MPR, the monetary policy rate is high, what you most likely see is that rates across board will generally tend to follow. So things like interest rates on government bonds, fixed income instruments, which forms a large part of our investments as pension fund managers, those rates will tend to go up. If they begin to reduce those rates will tend to go down as well. So those are the key things that we look out for. And even for contributors, generally, when you see the interest rates going up, it lets you know that you have the opportunity to earn higher returns on your investments, things like that. You also talk about the macro space, so many things. When the economy is doing very well, you see corporates doing very well as well. They would post good numbers, and that will filter into earnings, that will filter into dividends. That provides a lot of positive buzz and vibe around the equities market. And when things are generally positive in the equities market, you also see that reflect in share prices. The share prices go up, the market is doing well, and everybody is happy. But we understand that life is in phases.
Of course.
We also have different economic cycles as well. So you have periods of recession when the economy is not doing well. You also have periods of boom when the economy is vibrant, when the economy is doing well. So these different shifts influence and affect pension savings and savings in general, and how we as investors or as pension fund administrators who are responsible for investing this pool of cash that's been given to us, how we anticipate and how we, I don't want to use the word react, but how we respond, how we're proactive in managing the pool of funds in our hands, generally ensures that, irrespective of the cycle we find ourselves in, we're able to safeguard this investment as well as ensure that this pension fund savings and assets grow.
That's quite interesting. I think the only thing I would like for you to highlight a bit more on, you talked about how the interest rate affects more or less the macro space.
Yeah.
How does it affect the micro space? How does it affect the day-to-day lender? I've borrowed money from the bank. Interest rates are going up. Right? You sort of talked about how it can impact, savings and investment. How does it affect me who maybe took a loan for a mortgage or took a loan to get a car, right?
Yeah.
How does it affect my repayment back?
So it definitely affects it. So from an investment standpoint, investors like high interest rates because it means I'm getting higher returns on my investments. However, for borrowers, they're not smiling. No. Because it means that they're paying more,
of course,
on their debts, and they're paying more for on loans that they take. And that's why, sometimes when you have interest rates also really, really high, one could say it's also a sign that on a macro level, things are not quite where they are. And that could also negatively impact business because business owners are unable to have access to cheap capital to drive growth. And that could also crimp, or that could negatively impact the economy as a whole. So that's why for the central bank, it's really a fine balancing act. You want to raise interest rates to a point that you ensure that you don't have a lot of cash chasing too few goods, which could drive inflation.
Yeah.
But at the same time, you also want to ensure that you're able to put interest rates at a level that drive business, that drive economic activity.
Yeah.
And when that boom happens, we're all the better for it. So, like now, where interest rates are really high, last year, this year, although this year we're beginning to see rates gradually come lower, it's really been tough for businesses. Really, even for households, like you said, mortgage rates have gone up astronomically, and it's made things difficult. But I would say that the advantage we have, as a nation, is we've been able to amass this large pool of critical savings.
Okay.
Mass of critical savings. So when you look at the size of the pension industry,
uh-huh.
it's you could call it a huge pot of national savings, which, as pension fund administrators, we're always looking for ways to invest that can help drive economic growth and development, but at the same time, ensure that we're partnering or we're investing in bankable products that give return, but at the same time make an impact in the economy and in the society. So that's what you typically hear as impact investing. So that's one of the things we also try to do. So we're trying to ensure that we secure good returns for our contributors. We're making money, preserving capital, preserving purchasing power, preserving wealth, but at the same time, finding ways to partner within the industry among stakeholders to ensure that the kind of investments we're making actually have real impact on the society, real impact in the economy.
That's quite interesting. So, guys, I'm here for you because, as you can see, she was so focused on her investments point of view, forgetting that we are trading money every day, taking loans and paying back, and so that's why I'm here. That fine balance. But just to sort of take us, bring it a bit home. I always hear customers say things like, since you know that that there's that battle with inflation, purchasing power, there's that battle with FX and all of that.
Yeah.
Why not just invest all our pensions money in dollars?
Well, we're Nigerians at the end of the day, right? So we can invest everything in dollars. We understand the fact that our currency has been really volatile. We've seen the value of the naira depreciate over time. And our responsibility is to ensure that we make investments in such a way that, to a very large extent, we're able to hedge our investments and minimize the impact of currency devaluation on our savings pot, really. So as an industry as a whole, stakeholders working tirelessly to come up with regulation and ways that we can safeguard our pension savings. We do that in different ways. So we might not necessarily, invest 100% in dollars, but we can invest in real assets like real estate that help to preserve capital. We can also make investments in instruments that maybe give you dollar-linked returns. Those are the ways that we do it. But like I mentioned, first and foremost, right, we would like to invest in things that help grow help grow the economy. And once the economy is doing well and things are going okay, we won't all be chasing dollars, right? So we definitely look at a way to diversify our investments, and something that we're constantly working towards.
That's interesting. I mean, I think I'm here to give that fine balance, right? And so I would just like to add that what Ifoma has just said is a way to let you know that you have your money invested in pensions, but then there's returns on investments, right?
Yeah.
And what they try to do is ensure that your funds are diversified such that even when the inflation rate is and she's going up, you're getting the good end of it as well, because they are now investing in the kind of funds that will bring back those interest rates that will speak to your account and make sure that your return on investment is giving you that purchasing power that you need in the future, right?
Yeah, but just also to add to like what you're saying, I think it's very important for everyone to understand that savings, particularly saving for your retirement, it's not a like sprint. It's a marathon, really. And we're looking at performance over time.
Of course.
And like I had mentioned earlier, the economy is in circles. But the point is, when you average out over a period of time, say 10 to 15 years, you're whole. So it's like I mentioned earlier, it's a fine balancing act. So inflation last year, historical highs. But when you look at the rates on fixed income instruments, for instance, was below that. So when you look at it from a fixed income perspective,
it didn't matter.
Rates are negative, right? Your real yield is negative, but the equities market beat inflation over the last 2 years. So how do we balance that? You would see that fund managers generally would try to increase the investments they're making in equities relative to fixed income to help improve overall performance. But there would be years where you might see things are a bit down. There will be years where you would see your returns really high. Again. But the idea is, on average, over a period, exactly, over a period of time, you're whole. I think one of the challenges is when people look at, oh, this is where interest rates are, this is where inflation is now, this is what my return is right now. Oh, I'm worse off, I'm worse off, I'm worse off. But forgetting that, right? It won't always be like this.
Of course. It wasn't even always like this.
Exactly.
Anyway.
It wasn't always like this. So already we're looking at inflation, rebased inflation numbers that are out. We've moved from like 34 levels to like 24 levels in a month. So you see things are coming down a bit.
That's it.
Exactly. And then you're able to take advantage of opportunities that help improve investment performance. So it's just to encourage all of us, myself inclusive, that, you know, we should view this really from the lens of somebody who is running a marathon. Over a period of time, we would, you know, we should be whole. Exactly.
Okay, so I think I'll just have one last question and then we can wrap up. So on the client of Access ARM, what can I do differently in financial planning to ensure that my pensions is doing even better than maybe what it's doing right now? Is there, and we've spoken to the side of what we're doing as investors at Access ARM. Now, as a staff, I want to do more. I want to, maybe I've looked at my pensions and I've looked at my baby girl life now. And I'm thinking, is he really going to maintain that baby girl lifestyle for me? Is there anything I can do differently as a client of Access ARM?
Yeah, so there are things you could do differently. Although there are restrictions, you don't have direct access to manage your money yourself. You've entrusted that responsibility to us as Access ARM Pensions to do that on your behalf as investment professionals. But within your space, there are things you can do. If you have a sense of, you know, the kind of liabilities when, you know, like having your personal goals, how long do I want to work for? At what age do I want to retire? How much money do I want to be receiving on a monthly basis? And we have colleagues who can help with financial planning. When you arrive at that figure, you kind of get a sense of how much you can be saving. What a lot of people don't know is, you know, the current contributions that are being made by your employer and by yourself are the statutory limits. But you can actually do more. You can take advantage of the additional voluntary contributions to increase your pension savings. So people think you need to have like millions, but you can start from where you are, like you said. If it's an extra 5,000, an extra 10,000, an extra 20,000, don't underrate the power of compounding. You can make these additional contributions as well, and they help show up and buffer your pension savings. Another thing you can do, I would say, is with the multi-fund structure as well. It gives contributors some power back. Before, we just had like two main funds, the retiree fund and the active fund. Yes. But now you have the multi-fund structure, and that takes into cognizance age, takes into cognizance risk appetite. Exactly. And even your views on the market. So for instance, if you believe that, you know, the economy is booming, things are really doing very well, the equities market is just going to be a very good year for the equities market. And I am below 50, and I'm in RSA Fund 2, for instance, I can decide to say, do you know what? I think I want to go to RSA Fund 1 because, you know, it's a lot, the investment. Yeah, the risk appetite for contributors in that space is a lot higher. You can have higher investments in equity, higher investments in variable income securities, and, you know, that would do. I expect that to do well. And then you move there based on your views. And you can be maybe after a couple of years based on your views, if you think, I'm getting older, I need to take less risk, okay, I'll go back, you know, to funds. So those are options and opportunities are available to contributors. These are decisions that contributors can make, and little things at the end of the day that can help them improve and enhance performance on their retirement savings. One final thing to add is people also need to stay informed.
Yeah.
Myself inclusive, I'm guilty of this. Most times, the pension fund, what we do is on a monthly basis, in addition to the statements that I send, we send monthly reports where we provide updates on things that are happening in the economy, globally, locally, and how they have affected investment performance. We also show the broad allocation of the kind of investments that we make. But very, very few people, take time to look at those documents, understand. You look like you're guilty. My table. Very few people take out the time to read these things, and really understand where their pension funds are invested in, the kind of asset class. So it's just to encourage each and every one of us, take a look at them, take a look at these things, because it helps you stay informed and will also help you make investment decisions as to, should I move to a fund 1 or should I stay in an RSA fund 2? Or if I'm in RSA fund 3, do I move back to fund 2? Can I move back to fund 2? Those kind of things. So just the little things that, we can do as contributors to help ensure that we're maximizing our pension savings.
So interesting. Thank you so much, Ihoma. I even have learned a lot. I myself have been schooled. So just to add to what you said about the additional voluntary contribution is that it's pre-tax. Pensions in general is pre-tax, right? So your pensions is deducted before your tax is calculated. So what that means is your pensions reduces the tax obligations that you have to make to the government. And if you decide that you want to do additional voluntary contribution, let's say you want to do an extra 10,000, 20,000, 30,000, what that does for you is it just shaves off whatever it is you have to pay as tax at the end of the day from your gross. And that's moved into your pensions and you're making more money from it. And then, of course, you're saving towards this baby girl lifestyle retirement that we've been told, because it's so important to me. I'm telling you. Just say I will. So, and then also, just to also add to what Ifeoma has said about the funds, these funds are very versatile. You're able to look at it and just know that, okay, there's more investments in equities as opposed to, fixed income instruments. And you're able to make the decisions to say, hey, based on, I've had customers who have come to me to say, Adamu, and I'll say, no, you don't have the appetite for fund 1. I know you. I'm aware of who you are. Please say you want it so that I can have some rest. Because I have customers who are constantly checking their pensions every 2 days. And I'm like, no, you don't fall into the bucket of fund 1. Just stay in fund 2. But it's that information that empowers you to make the kind of decisions that allow you to take charge of your financial security and your pensions at large. So I don't know, do you have anything to add before we wrap up?
No, nothing.
So thank you. Thank you so much for being a part of this segment.
Thank you for having
taking the time from investing in our pensions to come and speak to us about it. Thank you.
Thank you for having me.
Thank you so much, my listeners, for taking time to spend these minutes with us. We hope that you've learned 1 or 2 things from our podcast session here at Pensions Playbook, powered by Access ARM. My name is Adele Zeraji. I remain your host. Until next time. Thank you.